SpaceX just pulled off the heaviest IPO in human history, raising a staggering $75 billion last week. Everyone on your feed is telling you to either FOMO your life savings into it right now or avoid it like the plague. But before you buy a single share or turn running, you need to understand the historical truth that Wall Street is hiding from retail investors. Welcome back to the Lunch Money Investing channel, where I'm documenting my daily grind to a $1 million portfolio by investing automatically every single day $15 to $35 into a highly aggressive, highly leveraged portfolio. In just a minute, I'm going to show you exactly how my high beta portfolio performed this week, including my positions in 2x and 3x leveraged S&P and NASDAQ ETFs, Bitcoin, and gold. But first, let's look at why this massive SpaceX launch might actually be a massive trap for your capital. If you've been following this channel for any time, you know I'm not here for safe, boring 7% a year returns. I'm chasing $1 million milestone with leveraged assets. Let's look at the weekly recap. My total portfolio value is sitting at $2,308, up 1.5% for the week compared to 0.6% for the S&P 500. This week alone, my daily automatic buying picked up $122 worth of shares, mainly in SSO and IBIT. The biggest winners for the week were in equities, of course, and crypto, which helped generate some returns for the portfolio. QLD was up 4.3% for the week, while IBIT came in swinging at 5.6% for the week. Because I'm using 2 and 3x leverage, when the market moves up an inch, I take a mile. The biggest drag to the portfolio this week was gold, down 2.5% as geopolitical concerns melted away with news of a peace deal with Iran. However, I was still buying up shares a single day via M1's Finance automatic buying. This daily dollar cost averaging is the secret sauce, and that's what brings me directly back to SpaceX. Why I'm buying automatically a leveraged index fund every day instead of dumping cash straight into Elon Musk's public debut. Let's look at the history. Look at this chart here next to me. This is the ultimate scale comparison of the largest IPOs in history. At the top, you see SpaceX raising $75 billion. Visually, it completely dwarfs everything else on the chart, nearly 3 times the size of the record before it. It feels completely historic, right? The next nearest IPO by size was Saudi Aramco, which debuted in 2019, raising a massive $25.6 billion. The hype at that time was unreal. Its one-year returns, a relatively flat minus 5%. Go back further to Alibaba in 2014, raising a significant chunk of change at almost $22 billion. A year later, the stock was down almost 30%. Yes, it did have a nice pop a few weeks out of the IPO stage, but after that, it was a straight move lower, and you did not recover the IPO price until nearly 2 years later. What about Visa? Their IPO in March of 2008 raised $17.3 billion, only to deliver investors a one-year return of negative 18%. And granted, it had an epic run since then, and this was during the great financial crisis, but still, investors took a lot of systematic individual stock risk unnecessarily. History proves that massive mega IPOs are a psychological coin flip. They are highly volatile and could trade flat to down massively in year one because of the massive initial valuations and carry extreme single stock risk. This is why at Lunch Money Investing, the strategy is built differently. Instead of taking my lunch money and gambling it on a single IPO valuation at its historical peak, I put that money into a leveraged broad market powerhouse like SSO and QLD. They will naturally pick up these newly minted stocks as appropriate. NASDAQ recently changed their rules to include SpaceX, so they'll be getting shares shortly and more than likely at a discount. Who knows, right? Conversely, the S&P 500 stuck to their rules and will wait for proper seasoning of 1 year and demand proof of profitability, both picking up shares potentially at their own respective times. And both are great. That's why I invest in both of them. By spreading my capital risk across the entire S&P 500 and the NASDAQ 100 and multiplying that with daily gains using leverage, I'm getting the math to do the heavy lifting. I don't need to guess if Elon Musk's stock is going to trade sideways, go to the moon, or get cut in half. I just need the American innovation and global markets to do what they have always done over time, and that's go up. Now, turning over to the macroeconomic data, inflation results delivered a mixed bag, which Wall Street reacted to with softer performance. On Wednesday, we got headline CPI data, which came in at 4.2%, the highest in nearly 3 years. Well, over 3 years, actually. Of course, energy was driving much of this move higher, right? And when you looked at core CPI, they came in at 2.9%, much more modest. Both came in line with analyst expectations, but the market closed markedly lower that day, as many on Wall Street and large institutions are pricing in higher for longer and stickier inflation. The next day, we got a leading look at inflation by the producer price index. On a seasonally adjusted basis, PPI increased month over month 1.1% versus analyst expectations of 0.7%. This stronger than expected inflation suggests that the consumer's inflation is not going to be transitory. It looks like it's going to be sticky and might even accelerate in the coming months. Looking to this coming week, we have BOJ and US Federal Reserve to release their latest policy statements and rate settings. On the BOJ side, Bank of Japan, markets expect a rate increase from 0.75% to 1%. And though this is still very low compared to the rest of the world, there's a lot of capital impacted by the yen carry trade. And this will only further accelerate the unwinding of those positions. Traders need to defend their current positions, liquidate, and get out of whatever aggressive position they might have. And this will result in forced selling of dollar denominated debts, likely bonds, which only puts upward pressure on US interest rates as well as other developed markets. In the US, Kevin Warsh is set to lead his first ever Fed meeting with rates expected to stay flat. Markets will be mainly looking at the tone and commentary of the new Fed chair to better understand the likely path of rates going forward. Now, if you made it this far, please give this video a large thumbs up. I'm tracking live and transparently my journey to $1 million. If you want to see if daily dollar cost averaging into a leveraged portfolio will actually beat single stock market pickers over time, you need to hit that subscribe button right now. I drop 2 videos a week, one every Sunday and one every Wednesday. The Wednesday video is my reactions to what's happening in the markets during the week, and Sunday, as you've seen, is a portfolio-wide breakdown. Now, if you can, please drop a comment below. Are you buying the SpaceX IPO, or are you building a diversified math-backed portfolio like me? Check the pinned comment below to see my exact M1 Finance allocation. Hit that subscribe button, of course. Protect your lunch money, and I'll see you guys on Wednesday and again on Sunday. Thank you.